With bombs flying in the Ukraine, crude oil spiked overnight and got to over $100 a barrel. And building on what we learned yesterday about identifying U-turns, I wanted to show you exactly how you would know when the run-up in crude ended. You can choose different time frames to do it. You know, the 1 minute would catch it faster, but you may also have some false breakdowns. I went with the 5 minute here, which is still a fairly small time frame in the big scheme of things, especially for the size of move that we just got in oil. So bear with me. The bar counting is a little tedious, but it's something that requires repetition to get correct. So if you actually follow along with me, you'll see exactly how we objectively define these swings and how that can tell us exactly when the price peaked. So this green line is yesterday's high of day, and around 8:55 p.m. we broke through there. So if we just start from there, and the exception that I alluded to in the past is what I call, when you have a hoagie, I don't believe that any of the movement within it is significant because it's all captured by this bar here. So that happened in a few different locations, but you'll see me make adjustments based on that, and I just wanted to explain that ahead of time. So here, let me put a line on here. Wherever this swing started, you know, call it right here, we went up to here. This was an outside bar. Really, the swing actually goes all the way up to here because we're discounting this stuff that's in here, and we did not take out the low of this bar. We took out the high of this bar. Then the same thing applies for everything that's inside this bar. So basically there, everything applies to what's inside of that bar. So that's basically, you know, technically there. Then this is a down bar, and then even though this tail hangs out down here, it's on this upswing. And that's all these two bars, several bars are within there. That's the next move down. Once we draw these, figuring out where the U-turn is will be very easy. This is an outside bar. Here they're getting cleaner and easier now. Now this is a big hoagie, except that actually pierced it, so it gets the respect of a swing. Outside bar gets a swing. Lower low gets a swing. Outside, inside, outside, down. So up is all the way to here. This is down, up, down, up, down, outside. These two both had highs at exactly 100. Back down, inside, outside, up, up, outside. So following along as prices rose, we had one leg down. Two, you could consider this a second leg down, except it didn't take out this low. Then we made a higher high, so we start the count again. One leg down, up, one leg down, up, higher high, one leg down. You could count this as a second swing, but it wasn't a lower low. And then we're going up, still not a higher high yet. So you can call this, you know, whatever you want to. It doesn't really matter. You've got another ABC down in here, and then here's a new high. So a new high gets one pull back, a new high. From this new high, we got one, two legs back, and then as you see, it broke. So this would have been your sell stop to get short, and your stop would be above the high. And let's put a little box there just to understand your risk level here. That's your risk level. You would have gotten short here and, you know, had some initial positive initial move in your direction, and then kind of a pullback not in your direction. And this pullback came in the morning. There was GDP news at 7:30, and then also you have the pit open at 8 o'clock. This bar right here, oops, is the pit open when the trend resumed itself. So the overnight structure was significant, but it would have been nice to see the pit opening within the context of that. And there are various other things you can do. If this amount of space makes you uncomfortable, you could try to sell halfway back up. So you can notice that this is breaking but not enter. And as we go back, you could sell the halfway mark of your risk, which it did tag right at 740. The risk of doing it this way, of course, is that it could just fall apart from there and you may not get an entry. But some people would argue that that doesn't cause any harm either. So it all depends on your risk tolerance and how you want to manage that. So the high here was $100.54. The low here was $99.04. That's $1.50. Upon this break, if you went for 2 times that risk, that would take you down to $96.04, a $3 move. And did we get there? Yes, we did. $96.04. It's about right there. So you would have achieved 2 times your risk by 11 o'clock. And that is how we catch these U-turns. And just for practice, let's continue to draw the swings. There's a swing down, there's a swing up, down, and this is chop, up, down, up. Now, if you're looking at a U-turn the other way, you've got A, B, C, but now here's the very clear distinction. This high is 99.68. This high was 99.69. So you didn't actually get a new high on that move. So really this could be looked at as one swing. And then had this level been taken out, and this was our 740 high that we made, that would have been a U-turn. So again, these would have been great shorting points, and rather than even using the high over here, you knew that taking this point out would be a U-turn to the upside, so you could have shorted with even tighter risk at this point. And then let's see, down, up, down, up, down, up. That's a down, that's a down, that's an outside, so it's a down, that's an up, that's a down, that's an up, down, up, down, and this is all up because these are all outside bars, outside, outside. So once we got the U-turn, you can see that we tried to get an ABC up here, but that was not taken out, and even the pit bar could not do anything about that. And then we ended up with lower lows, lower highs, lower lows. And here we did get a solid ABC up, where this is 98.08, 98.24. So that would have been a U-turn spot where the downtrend would turn up. So again, when you got this move up here, you could have shorted with impunity, knowing that your stop was very close behind. And then again, only one leg up, one leg down. And this is still technically one leg up. We'll see what's going to happen here. If we get above this level here, then we'll have the other type of U-turn potentially setting up, which is a higher high, higher low, and then turning up from there would be the U-turn. So this is, again, how you follow the structure and stay focused, and you'll find the good risk-reward opportunities. On this play, you had a mechanical way to trade this U-turn and get twice your risk. If you kept following along, you noticed this U-turn point, which gave you a low entry short on the pit open. When you saw this U-turn form, this gave you another low risk short. And that's all we're doing here, and it just takes a lot of repetition and practice. If you have any questions, please feel free to ask them. Please post a like and subscribe, and there'll be more content coming your way.